Hey everyone, Cameron Brioux here, and today we're diving into the Canadian real estate market. There's been a lot of buzz around recent rate cuts by the Bank of Canada, cuts that were supposed to breathe new life into the real estate market. But here's the thing, those rate cuts haven't delivered the boost that everybody was hoping for across the country. Even with recent reductions, sales are still falling. That said, expectations for lower rates in the future are building, with many analysts speculating that the Bank of Canada's rate could drop even more. It's interesting, isn't it? On one hand, you've got CREA, the Canadian Real Estate Association, coming out and saying that despite the sluggish market right now, 2025 is going to be a slam dunk for real estate. But at the same time, they're acknowledging that recent rate cuts haven't had the desired impact. It's a bit of a contradiction. If rate cuts aren't helping now, why would they suddenly transform 2025? And most recently, they updated that state to say that buyers will be holding off. So today we're going to dig into what's really happening in the Canadian real estate market, backed by data from Edge Analytics from their October Metro Deep Dive. We'll look at why inventories are building, why sales are slowing, and what this could mean for buyers and sellers and even some investors that are out there. And most importantly, I've got one critical piece of data that could give us a solid indication of where markets could be headed over the next 12 to 18 months. Keep in mind, this is not a forecast. This is an evidence-based analysis of the data. How you choose to interpret it is up to you, and I do encourage you to do so. And let me know down below. Before we dive in, if you're new here, welcome. My name is Cameron Brioux. I am a licensed realtor in the province of New Brunswick. Make sure to hit that subscribe button for more Canadian real estate insights. And give this video a like to help others find it too. To kick things off, CREA recently revised their forecast, lowering their expectations for home prices and sales growth as inventories continue to build across the country. What's really happening is a classic supply and demand imbalance. There are more listings coming out of the market, but there are fewer buyers that are actually showing up. It's a trend that we've seen play out in previous market cycles, and historically, it doesn't end well for prices. In fact, recent data shows that national home sales fell since July, despite the first rate cut in June. The expectation was that lower rates would draw buyers back into the market, but the numbers just haven't panned out that way. Now, there could be a lag effect here, folks, but some time has passed, and we simply are not seeing a huge difference in the market. So now we're in a situation where we have more listings, fewer sales, and as a result, the market is gradually shifting towards a buyer's market. But the story doesn't end there. We need to look at what's happening regionally, because not all markets are affected in the same way. Some areas might present better buying opportunities than others, depending on inventory levels and local demands and trends. And while CREA's prediction that 2025 will be a banner year for home sales seems optimistic, there are several factors that could tamper with that outlook. So let's get into specifics, and I will highlight what's going on in major cities like Toronto, Vancouver, Calgary, and Edmonton. And we'll look at how these different regions are reacting to the same macroeconomic forces. Listen, I can hear you saying it, but Cameron, you don't mention my area. Noted. Thank you. This is the selection of data that's being offered up by Edge Analytics as part of their October Metro breakdown. And for the most part, these major cities drive the news narrative in Canada, and they also make up the bulk of the Canadian housing market. So yes, those of you telling me in the comments, markets like the Prairies and Quebec and Atlantic Canada, specifically my market in Moncton, recent data does support growth. To start, we're seeing an interesting trend in the macro landscape. Canadian bond yields have surged by 40 basis points since mid-September, driven by stronger than expected US economic data. This has put a hard floor under fixed mortgage rates, meaning that any hopes for significant rate cuts in the near future might not materialize. Historically, when we see bond yields moving up this aggressively, it usually precedes a period of economic turbulence, especially in a debt-heavy economy like Canada's. Our household debt service ratios are at record highs, which means higher rates disproportionately hurt us compared to the US. So we're caught between a rock and a hard place. Do you keep rates high and watch household finances struggle, or do you cut rates and risk stoking inflation again? But let's look at the bigger picture. Edge notes the Bank of Canada will likely diverge from the US Federal Reserve out of necessity. And if they do, we could see significant weakening of the Canadian dollar. And while this might help boost some exports, it could make importing goods more expensive, potentially keeping inflation pressures high. So, in other words, we might be looking at a prolonged period of economic uncertainty where rate cuts may only come in when things get significantly worse. So, while CREA notes that 2025 could be a slam dunk, many buyers might be on the sidelines even longer. Toronto's market is showing signs of stress. Sure, sales are up 3.3% in September, led by the detached segment. But when you look closely at the data, it's the surge in inventory that's the real story. New listings are up almost 10% month over month, pushing the active listings to their highest levels since. Now, this isn't just a one-off. The data shows a mean reverting pattern in the new listings. And we're only back to trend levels after nearly 2 years of unusually low inventory. Historically, when we see rapid rise in inventory, price weakness generally follows because the market tips towards the buyers. This month's 0.5% drop in the MLS house price index could be the beginning. The bigger concern is the 7.1% year-over-year decline in condo prices, and if history is any guide, this inventory build could lead to more price correction. Changing gears to rentals, average condo rents in Toronto have fallen by about 7% year over year. And you combine that with the 140 some odd thousand purpose-built rental units in the pipeline and another 160 or so thousand condo units, half of which will likely end up in the rental pool, we're looking at potentially significant rental oversupply. Historically, we know that the rental demand softens when supply outpaces it, especially if the federal government succeeds in reducing the non-permanent resident population. If that happens, the rental market could face some tough years ahead. The bigger picture here tells us that Toronto's market is entering a new phase, one that's characterized by a shift from chronic undersupply to potential oversupply. Consider this, the 20-year highs in months of inventory for both condos and single-family homes in Toronto suggests that we could be in for a long-term correction. We've seen this play out before in the early 90s and again in 2008 when supply surged and it outpaced demand. Prices didn't just slip temporarily, but they tend to stay soft for years. Now, turning to Vancouver, we're actually seeing some similar dynamics with some regional differences. Sales rose by 4.2% in September, but once again, inventory surged, with new listings up about 12% month over month. Inventory is now at its highest since 2014, and the sales to new listings ratio slipped below 40%, which could indicate that we're moving towards a buyer's market territory. So just like Toronto, historical data is clear. When the inventory builds like this, price declines usually follow. We've seen about 0.5% slip in house prices for September, but this could just be the beginning. Months of inventory is up and construction activity is falling, with housing starts down about 18% year over year. This combination of softening prices and declining construction usually signals a cyclical downturn in real estate. So the slowdown in construction, specifically for single family homes, could set the stage for future tightening in the market, but it's still a long way off. Historically, when a market like Vancouver has been flooded with inventory, it has taken years for it to return to a seller's market. The long-term outlook for Vancouver is a bit of a paradox. On one hand, you have the slowdown in construction that will eventually help the market rebalance. But in the short to medium term, we could be looking at continued price weakness, particularly in the condo segment where inventory is already 40% higher year over year. If you look at the history of Vancouver's real estate cycles, you'll see a clear pattern of periods of rapid inventory accumulation are usually followed by multi-year price corrections. So this isn't to say that Vancouver's market won't rebound, but it might take several years before we see that meaningful price appreciation again. But who knows? Maybe all the first-time home buyers will be buying up the $1.5 million homes, and this isn't really an issue at all. Over in Calgary and Edmonton, we're seeing the tale of two cities. In Calgary, inventory has surged by 134% since January. This is the fastest pace of accumulation since 2006. While Edmonton's inventory remains at decade lows, Calgary's market saw sales decline of about 2% month over month, while Edmonton held steady, marking a divergence that could continue into the next year. Historically, rapid inventory builds in Calgary have been a signal of upcoming price weakness. When inventory surged like this in the past, such as the oil price crash of 2014 and 15, we saw prices take a significant hit. This time, much of the surge seems to be from investor activity, especially in condos, which makes the market a little bit more volatile. However, long-term fundamentals for Alberta's real estate market do remain strong. Calgary and Edmonton continue to be more affordable than other Canadian metros, and population growth driven by interprovincial migration supports long-term demand. We're seeing strong inflows from Ontario. For example, as people seek more affordable housing options, they're heading west. It's just my opinion, but for Calgary, the next 12 to 18 months could be rocky as the market does digest the surge of inventory. But over the long term, the city is positioned for growth, especially if the population trends continue. From my personal experience, I have seen many investors that have sold here in Atlantic Canada and or diversified into Alberta, with the most attractive market being the condo segment and then purpose-built multifamily rentals. All right, so here is the key data point that I wanted to highlight. Consumer insolvencies in Canada are climbing back to levels that we haven't seen since the pandemic, and they're accelerating. This surge signals that rising interest rate costs, which are driving up CPI and pushing up inflation, are putting significant financial pressure on Canadians. If this trend doesn't improve and the Bank of Canada doesn't step in and do what needs to be done, things could escalate quickly. The near-term outlook suggests more price corrections could be on the way, particularly in oversupplied markets like Toronto and Vancouver. And if history is any guide, markets with significant inventory builds typically take years to return to sustained growth. If you found this video helpful, don't forget to like and share it, and subscribe for more real estate insights. Drop a comment down below and let me know your thoughts. Do you think that we're headed for a long-term correction, or will the market rebound sooner than expected? Thanks for watching, and until next time.